Alright, in part 2 here, we're going to work our way through some discussion about corporate bonds, and then we'll move on to the actual valuation of debt. So corporate bond obviously is a borrowing instrument. It's a debt instrument. Identifies very clearly what has to be paid. There's a contract. We'll talk about that in a couple of minutes. The coupon interest rate is the interest rate that's paid annually. Sometimes annually itself, sometimes it's paid semi-annually. The par value is the principal of the loan. It's the face amount. For a corporate debt, it's always $1,000. And of course there's a maturity date, when the bond matures. Now debt, corporate debt, is different from a mortgage or from a car loan. When we did the time value chapter, we talked about breaking a loan payment into interest and principal. That is an amortized loan. But a corporate bond and a government bond essentially are interest-only loans. So all you pay is interest, so the principal remains the same. You pay interest every year, and then when it matures, the loan is paid back. So the bond indenture is the contract. It sets out the rules and guidelines that have to be followed with respect to the debt. Now there are certain kinds of rules. We talk about things having standard debt provisions or covenants, right? The standard debt things is, it's in every loan. Every loan has these rules in it. You have to pay back the interest. You have to pay the principal. You have to pay the interest, right? You have to maintain financial soundness. All of those things are things that everybody has to do when they borrow debt, when they borrow money. The restrictive covenants, though, are special things. They're placed on individuals based on their financial soundness, right? And the less sound the company is, the greater the risk of the company, the more these restrictive covenants are added. And of course, restrictive covenants, if nothing else, restricts the flexibility of the company, but they could actually, the companies could actually incur some costs associated with following these restrictive covenants. There's something called a sinking fund. A sinking fund is where the corporation is required to put away money every year to ultimately pay off the debt when it matures. So again, it's like a systematic savings fund, if you will. You put away money, and this money then ensures that when we get to maturity, we'll be able to actually pay off the debt. Some bonds have what are referred to as a security interest. There is an asset that is used as collateral to protect the debt itself. Now, one of the things with collateral that's important is collateral doesn't make the debt less risky. It just provides an asset to cover the debt should the company default on its debt. A trustee is kind of like a referee, right? They make sure that the different parties follow the rules. And if you think about it, the party that they're going to watch are the only ones that could mess up the bond arrangement is the borrowers, right? So we want to make sure that the borrowers do what they're supposed to do to make payments and to maintain the soundness of the company. So what do we know about the costs of debt? And there are some basic rules and guidelines. The longer the bond's maturity, the longer the lifespan, the higher the interest. Makes sense? You want to borrow for 1 year versus 30 years. 30 years is more uncertain, so I want to have a little bit more return. The larger the size of the offering, the greater the debt, the greater the risk, the more return I want. Default risk. As companies, as we analyze companies, we find companies have varying levels of debt, varying levels of ability to pay. Liquidity of a company is always at issue. As those things change, the default nature of the company could change, and we want to make sure that we get compensated if the company becomes riskier. And then finally, as interest rates in the economy change, we know that the interest rates and the returns that are desired by the lenders of debt, the investors, also is going to change. A couple of features about bonds in general. There is something called a conversion feature. Conversion feature permits an investor to change their investment from being a creditor to being an owner. And there's certain rules how that happens, and of course the investor is only going to do this when it makes sense, when they're going to make money from the transaction. The call feature, though, is a little bit different. It is actually driven by the corporation themselves. This is gives them the opportunity to repurchase the debt, and usually they would only want to repurchase the debt if they wanted to refinance the debt. So if interest rates have fallen substantially, a call feature, it could be likely. Again, there are rules that determine how and when this can be done. The call price is the price at which they would actually pay to repurchase the debt, and the call premium is the difference between the call price and its par value. Typically, this is going to be the call price is 1 year's interest plus the par value. So the call premium is the interest, or the 1 year's interest on the debt. The three most cited yields are listed here. One is referred to as the current yield. It's the coupon divided by the market price. So if you buy the bond today and you receive this coupon, that's the interest, the return you would earn in year one. Yield to maturity is obviously, we talked about this before, it's the return if you buy the bond and you hold it till it actually matures. Yield to call is the return from today until the very first opportunity for the call. So if we have a 30-year bond, but it has a 10-year deferred call, we could calculate the 30-year yield to maturity, but the yield to call would be, what would the return be if I bought today and it was recalled or repurchased 10 years from today? Most corporate bonds are purchased not by people but by institutions that are driven by cash. Certainly individuals, retired people at lower tax brackets, from time to time they're obviously interested in investing in bonds. However, there is a higher interest rate on bonds than there is on dividends. So there is a difference in what kinds of people really are interested in buying bonds. But bonds are always quoted as a percentage of par. So here we have a 94.007 bond. That's the bond quote. Well, you just move the decimal place 1 point to the right, and this bond sells for $940.07. So we can see here from these bonds, we have some bonds that are selling at above 100%, right? So this bond at the bottom would be selling at $1,008.76. The bond up here would be selling for the one above it, $951.40. But look at this bond up here, $998. Well, that bond is selling for $9,985.21. But that is, this bond, company A bond, is probably not a $1,000 coupon bond. It's more likely a $10,000 coupon bond. There is a rating system. There is the Standard & Poor's, Moody's, a couple other companies analyze companies and give them grades based on their default. At the high end is prime quality or investment grade. In the middle we have speculative issues. And of course at the very bottom we have bonds that are actually in default. So going down this list, we go to riskier investments. And this actually is part of the challenge that we had in our most recent downturn with the mortgage markets, is that the rating companies were not rating the securities properly. That is, that they were establishing a much higher quality level, saying that the bonds were less risky than what they actually were. And of course, since you purchase based on what the rating agencies talk about, investors were buying bonds that they thought were much safer than what they ultimately were. It's a very big issue, and I think there is ongoing legislation and regulation that will come about to make sure that that there is a distinction between the bond raters, the people that rate bonds, the companies that they're rating. We want to make sure that there's no collusion going on. So there's obviously things to come with respect to those rating companies, and in the end, how they function. So what kind of bonds do we have? Right, in the corporate world, we have what are referred to as unsecured or junior debt. Frequently, those are referred to as debentures. Right? A debenture is an unsecured corporate bond. Some of these have a higher status, if you will, than others. That's what the word subordinated means. Subordinated means it's junior or it's below. Now, income bonds also fall into this category because they don't have security. There's no collateral. But an income bond pays its interest, and principal is paid from the project or the revenues that come from projects. Secured debt or senior debt has collateral. Real estate is a mortgage bond. Equipment is a trust bond. And of course, a company could use its investment portfolio as what's referred to as a collateral trust bond. We have bonds, obviously, that are international in nature. The general definition of a euro bond is a bond that's issued by a company and it has a currency that's different than its own. A foreign bond is a bond that's issued in a host country's market, in the host country's currency, but it's by a foreign borrower. So in this case, if a Japanese company wanted to issue debt in their country, but they wanted to issue it in our country in dollars, we refer to as a foreign bond because it was issued by a foreign entity. The general impetus of this, the general importance of all this, is really the currency, right? How strong is the currency? What is the risk associated politically with the economies of those countries with that particular currency? And of course, the people who are borrowing are certainly interested in that, but quite frankly, more interested in that are the investors in bonds. So let's move on and talk about valuation. Valuation essentially is the process that links risk and return to determine the worth of an asset. What would you be willing to pay to buy an asset? In fact, let's say a little bit different. What is the maximum you would be willing to pay to buy an asset? And there are three things we need to know. We need to know something about the cash flows, the timing of those cash flows, and we need to have an understanding of the risk of the asset and the company that we're talking about. So the basic bond valuation formula is a present value calculation. It's the present value, the cash flows of the bond. So if you buy the value of any asset, then we need to forecast cash flows. We need to know the time that the cash flow is going to be invested in. And we also need to know, again, this required return that ultimately encloses or includes the riskiness of the company and the asset. So our basic investment rules are, if the value is greater than or equal to the price, you would be willing to buy the asset. The price is known, so we have to solve for value. An alternative rule is that if the expected return is greater than or equal to the required return, you'd be willing to buy the asset. So the expected return is the return. If you buy it at the current price and the cash flows that you've predicted actually happen, what return do you get? In this case, since we're talking about bonds, the rate of return we're talking about is the yield to maturity. So if the yield to maturity is greater than or equal to the required return, then you would want to buy the bond. In this case, remember that required return reflects the risk of the company. In this case, since we're talking about bonds, it's going to be identified by the rating level. AAA rating being the least risky of all the bond ratings. So here we have a company, right? They have a 10% coupon interest. It's a 10-year bond, and it's $1,000 par value. So if you buy this bond, what do you get? You're going to get $100 a year at the end of each year for 10 years, and then you're going to get the $1,000 par value at the end of the 10th year. So if we were to assume here that the required return equals 10%, again, just to start our example, what would be the value of this bond under this circumstance? So if we move forward, there's a bond valuation spreadsheet. Here are the variables. We need to know the par value. It's always $1,000. The annual coupon, you were told it's 10%. The required return was given, 10%. Time to maturity was 10 years. Compounding frequency, we're just going to assume it's 1 for right now. This bond has a value of $1,000. Now, it's rare that a bond's value and its par value will be the same. It only happens usually twice in a bond's life. Once when it's issued and once when it matures. In between that time, in between the time it's issued and the time it matures, the bond price changes. The interest doesn't change. The time gets shorter and shorter and shorter. So the only thing that really changes is economic conditions and the risk of the company itself. So as those conditions and the risk of the company change, the value of the bond is going to change as investors change their required return or their expectations of returns for the particular bond. So if we go back to that company, the Mills company we just looked at, what would happen if the bonds, if it rose to 12%? Well, if it goes from 10% to 12%, the value goes to $887. In fact, we say that this bond is now selling at a discount. And what a discount means is that the price is less than par. If the interest rate or the required return fell to 8%, if the company became less risky, the bond price goes from $1,000 to $1,100. We say that that bond is selling for a premium. Now, don't get hung up on the discount premium idea because they're meaningless. It just tells us where the price is relative to par. It has nothing to do with good versus bad. Just as a reminder, we talked about yield to maturity. It's the rate of return if you buy it today and you hold it to maturity. So the yield to maturity and the coupon will be equal only when the current price is equal to its par value. So if the par value, if the bond value differs from par, then the yield will be different than the coupon interest rate. So the return changes as price changes. So here's a bond, 10% coupon, par value is $1,000, 15 years. It has an 8% required return. What's the value of this bond? And if you could buy it for $1,100, would you? Plugging the information into our formula, we see a couple of things. Number one, the current yield, 9.09%. So if you bought this bond today for $1,100 and you received $100, over the next year you would earn a 9.09% interest. The value of this bond is $1,171. So the first investment rule is if the price is greater than or equal to the value, right? Excuse me, if the value is greater than or equal to the price, you would buy. So in this case, you would spend $1,100 if you were going to get $1,171 back. And of course, we then can look at the yield to maturity. The required return on this debt is 8%. If you bought it for $1,100, you would earn 8.78% if you held it to maturity. So this is a good bond investment. What if we have 12%? 25 years left in maturity and 10% required return. And this bond's callable in 10 years. The premium, the call premium, is $11.20. What would that do? Well, if we could buy this bond for $1,050, the current value is $11.81. So we'd want to buy it at today's price. If you held it for 25 years, you'd earn 11.39%. But if they called it in 10 years, you'd actually earn 11.81%. So which would you rather earn? Would you rather earn 11.3 or 11.8? So your hope is that this company calls this debt in 10 years. What's the likelihood that that would happen? In other words, when would companies want to repurchase or call their debt? We'll talk about this in class, but the basic idea of repurchasing is refinancing. So when interest rates fall, the chance of call goes up. So what again about interest rate risk? We're going to kind of finish this up. Interest rate, when interest rates change, it changes the value of the bonds. Why does interest rate change? It changes because of things in the economy. It changes because of the risk in a corporation. So rising rates are going to reduce bond prices. Rising rates are going to increase the required rates of returns of investors. If you want to get paid more, the only way you're going to get paid more is if prices fall. So the shorter amount of time there is, the less responsive it's going to be. So we have, again, a 30-year bond. When interest rates change, 30 years is a long time, and there's going to be a far more greater change in price in the long haul than if we only had 1 or 2 years left on the maturity of the bond. There is a way to measure this risk. It's beyond the context of the course, but if you look at the spreadsheet, there is a number there that's called duration. And duration is a measure of interest rate risk. One of the things we can see about bonds is that no matter when you buy them, the two bonds we talked about a little bit earlier, one was priced at $887, the other was at $1134, that when it matures, it has to be worth $1,000 because that's the check you're going to receive when it matures. So you earn cash, you earn interest all along this time frame, and then when it matures, you're going to end up with a value of $1,000. In class, we're going to switch this graph just slightly to talk about two different kinds of bonds, so you can kind of get a feel of why people buy bonds and what is the strategy behind that. So that's the end of the bond chapter.